for coming to our first talk of the semester, and I'm very happy to have
Thank you.
Irene Aldridge from Able
Thank you.
Alpha.
Markets, no, Able
Markets.
Yes.
And well, I've known Irene for about, what, maybe 10 years now?
I think so.
When I started writing papers in market microstructure, she was writing a book on high-frequency trading, and we kind of talked a little bit about sort of that early literature in that area. And anyways, and since then she's sort of explored new areas, such as and a book of hers actually just came out.
It's coming at the end of the month.
It's coming at the end of the month. Okay,
yes.
So and it's called Realtime
Risk.
Realtime Risk, and I guess today's talk is the connection of this with the long-term investment.
Yes. That's all I think about nowadays.
Okay, so I'm very excited to have you.
Thank you so much, Ashton. Thank you. Hi, my name is Irene Aldridge, and thank you so much for coming. I greatly appreciate it. And just by maybe I'll just start with this first. So what we're going to talk about is what is real-time risk and what are its causes, and how does it impact investments across different strategies. But I think specifically today I want to address the common misperception that real-time risk does not affect long-term portfolio managers. And for example, the other day I was on a panel in Chicago, and there was a gentleman next to me, and he manages $1 billion, and it's a long-only fund. And he said, I don't care about high-frequency trading because it doesn't impact me in any way. I said, well, that's interesting because it's something new, right? Because we've had the last 10 years of long-only portfolio managers campaigning against high-frequency trading because it was really damaging their stuff. He goes, well, they just trade around, and I just hold it for a long time, so there's no harm done, and nobody cares. And he goes, and even if they cause flash crashes, I don't care about it either, because typically at the end of the day, flash crash is over and the price goes back up. So it's all good. So bottom line, what we're going to talk about is it actually does affect the long-term portfolio managers, and we're going to talk about how. So really what I want to talk about is what are the systemic changes in the marketplace, and how they impact what we do, and everybody does, and what does it imply for portfolio managers, whether long-term or short-term, and et cetera. Okay, so my background is really well, funny enough. So I did electrical engineering at Cooper Union for my undergrad, which I kind of landed there almost by accident because I really wanted to do computer science. But Cooper Union offered me a scholarship, so I took that. And my parents were very happy, obviously. But during the program, we did a lot of this SVD, or what now is called big data, in MATLAB. And I had absolutely no idea why we're doing it and what the applications were. I mean, it was interesting from the mathematical point of view, but it was kind of, it's just something to get a grade in the course. And now it's all the rage, to the point that a friend of mine who just stopped being a high-frequency trader, and he deploys the same techniques now from this space, and also from high-frequency trading in the advertising space in California. And it's like a huge demand for this kind of very sophisticated, not just SVD, but very sophisticated analytics that people are just lapping it up, and it's really becoming commonplace. So anyway, so after Cooper Union, at the same time, I was working a lot in software development, and later software architecture. And I had my own .com back in '99, where we did software security. And later I moved into risk. I also was at grad school at Columbia in financial engineering department at IUR. And I did an MBA at INSEAD, and I came back. And I was in grad school doing finance. And I was also doing a lot of consulting in risk management. It was after the 2000 crisis, so risk management was very hot. And so I ended up on the loan pricing desk as a quant, and I actually had the team several people where we were pricing loans. And even then, we already had SaaS. It was a pretty sophisticated operation in that sense. But a lot of stuff we had to do, we had to still negotiate with human people, human loan pricers, and they had the scorecard, and they would only give 10% to the quants, like of the total value of the loan, of the credit rating, and it was commercial loans. So we would it was valuing the company's creditworthiness, and they had a scorecard in which only 10% was input from quants, and 40% was input from the loan assessor's personal judgment, personal feel about how this, based on his interactions with the CEO and management of the company, how they're going to perform. So of course, this has changed dramatically now, and we have companies that are quantitatively pricing loans in like microseconds, right? When you just fill out the application, and there's a big fintech space in that, that's all people do based on Roger Altman's models and stuff like that. So, I left the loan quantification, and I did a stint in research. And I did actually research before at Goldman too, but I did a stint in research in ETF space, and then I ended up as a quant on the trading floor. And there, I was very surprised because nobody even had SaaS at the time. And really what people had was Excel. And it was completely manual. It was foreign exchange desk. It was completely manually traded. There were these long rows of people just sitting. They had computers and they had their Excel spreadsheets that were Bloomberg or whatever, Reuters was streaming in the data. And they were just kind of pressing buttons. So they had these displays and they were clicking point-click trading. And in many cases, they were losing money, right? But in one extreme case, there was a lady who was in charge of trading Australian dollar, and she was so superstitious about her trading, like she would only walk in through the side door, through a very specific side door onto the trading floor, because she believed if she walked through any other door on the floor, she would have a losing day. Right, so but that was her good omen if she went through that one specific door. So that's kind of how people traded, and it's true. And it was like literally only 10 years ago. And so now, fast forward, not only the loan pricing is completely automated, excuse me, or for to a large extent is, but also where we're going today is equities are largely automated. So all the trading in equities is automated. And today we really have a lot of automation happening in foreign exchange, which already had seen the first round of automation. And there is a lot of stuff that's been built, but now really are really going into it and making it completely automated. And the same with fixed income and the same with commodities. There's really a big push for automation. So what automation creates, something interesting. So it's designed to really replace human trading, right? And human traders know that, right? So when I appeared I was the first quant on that particular trading desk, and there were like 50 traders at that time. They were highly resistant to sharing any information. Like they knew what was happening. And they had most of them were there for 20 years at the time. So they had some intuition, which is in a sense, kind of analysis that they have seen over and over how the market moves and what happens during specific points in time when they execute this trade or that trade. So they had some ideas, but they didn't want to share what these were because they kind of had a sense that if they did, they would be immediately automated, right? And this is what happened anyway. So my former boss literally now bakes cookies, right? And the guy who was sitting next to me is a real estate agent, and because they just it's what is going on in the industry in general. But the people who sort of quote unquote survived. They really embraced big data and machine learning, and they really try to stay kind of current, not too current because then it's too visible and it's threatening to other people, but like up to date enough to really have a meaningful conversation, without like appearing to be overly smart, etc. But anyway. So bottom line is it's all happening, and it maybe has happened. And now, of course, we have this big data. And I remember 5 years ago, there was a conversation that people were really fed up with the term big data. And they were, I like my LinkedIn a lot, and I get most of my news from LinkedIn. And so there were these conversations about, like people are just going to puke if they hear big data one more time, because it's just so annoying and it's so meaningless and blah, blah, blah. So lo and behold, we fast forward 5 years, and big data is everywhere, and everybody is doing big data, and people really have huge amounts of data now. Okay, 5 years ago, if you went, or it was 2007, so maybe 10 years ago now, we were talking with one of the big banks, and they didn't have any data on commodities besides the 21 days that was required by the regulators. Actually, it was not even 2007. It was like 2009. But anyway, so that's all the data people had, right? So they had just 21 days of data, and they couldn't build any models. They couldn't really do anything with this data, except maybe some toy kind of things and here and there. And now, there people are building databases. They're streaming. There's structured data, there's unstructured data, and all of this has to be processed in a lot of different ways. Now, one of the most interesting applications is a lot of the people who are working with data today, or who are managing teams working with the data, they are trained on daily data, on small data sets with daily data. Okay, so now they're surrounded by this huge amount of data, and one of the interesting and growing opportunities everywhere across Wall Street is really taking those giant heaps of data and converting them into small data, so the experienced researchers who are used to smaller sets of data can actually make a meaning out of it. And this is where we come to SVD. So it was a long story, but it's SVD is singular value decomposition. It's basically principal component analysis, and it's a fun kind of thing. It evolved in many different ways, but it used a lot in digital imaging, et cetera, et cetera. So, and we're going to apply it to portfolio allocations. So portfolio allocations also is one of those industries that's on the brink of being automated. There are already a lot of people who are doing passive portfolio allocation, so they invest in ETFs or sectors instead of really hand-picking the stocks. However, today we had a meeting with like a $20 billion fund that is very well known, and they still do it the old-fashioned way. So they have researchers who research monthly data on different stocks, and based on their analysis, they say they want to invest in Starbucks, and they allocate $1 billion to Starbucks. So they take like highly concentrated positions in very few names, and they hold them for some time. They also do some activism around it, so there's other issues involved, but there are all sorts of kind of ranges. But even these guys who are doing monthly data presently, so what their main initiative now is to get in as much data as possible and bring it to the portfolio managers, so that portfolio managers have the information they may not otherwise have, so that they can incorporate it and improve on their decision making. Okay, so that's part of the big data. But this SVD is one of the key big data techniques. And essentially, its main value is that it allows you to reduce the data. So you take a huge amount of data, and with SVD, you make it a very small amount of data. Okay, and then it's manageable, and even in an Excel spreadsheet, if you like, and basically what it is. So like a lot of Google advertising, or you have Google or some stores that have a bunch of customers with different customer values. Like this allows you to figure out how you can classify the customers in the simplest possible way, right? So from just complete cloud. So And again, there's a lot of art as well as science. It's not obvious, but all right. So it's used very widely. Here's a very basic example where you have an image and it has 400 vertical lines. Okay, so this is the image. It has 400 vertical lines in it, and so it's 400 vectors. And so you do SVD on it, singular value decomposition. It comes out with a bunch of singular values. So if you just use one value, this is what you get. Okay, when you plot this one value, if you use two values, this is what you get. So it's 2 dimensions, 10 values, the picture looks like this. And then 50 values, it almost looks like a complete picture. All right, so now you take out of 400 columns, you reduced it down to 58 columns, and you basically have the same image as you had. That already it's not perfect, but for the purpose of research, you know, it's pretty good, right? And the rest you can consider noise. Or some people discard the first 50. It depends on your application. You may choose to discard the first 50 values and only focus on the noise if this is what you're looking for. If you're looking for something that's very specific. Yeah.
In this application, this
Sure.
math, would you say that if you go from, let's say, tick by tick to week to minute by minute, would you consider that within this terminology also reduction of dimension?
Yeah, I would say so.
You would?
Well, it's a very good point. So there are different ways to organize the data, right? So one way you can do that, in this example, one way you can do it, you can put the tick by tick as columns, okay? So in that case, you can, it's basically shrinking the number of columns. It's not shrinking the number of rows, it's shrinking the number of columns. So if you organize your data in such a way that you have ticks actually lining up this way, right, then you would shrink them.
To throw out, let's say.
Yeah, it's more complex than that. So it really allows you to not just throw out it really allows you to determine the important ones.
Capture the change.
Yes, capture the change, or some of the ones that have most variation. Technically, it's most variation. So it's really, you're keeping the ones that you basically, you're projecting into a hyperplane that where with the most dimensions. So instead of like this is XY axis, your optimal XY axis may be looking like this, and so you're changing the axis to really to kind of accommodate the data and the biggest variation where the information is. But potentially, yes. I haven't really looked in that specific idea, but it's a good idea.
So here,
yeah.
It's 400 pixels basically, and each of them are grayscale from white to black.
Yes. So each would be 0 to 55.
But what you're saying here is you don't need a vector of dimension or 400 vectors to describe an image.
Right.
You can describe it with only.
Yes. So in this case, I mean, its picture is still grading. So each of these is a vector, right? So these are 400 vectors vertical in this picture, and so we're keeping 50 of them here, right? And then, but it's not like we're just throwing out every other vector. Like it's more that this singular value decomposition determines for us which vectors are important to keep, and we're keeping those vectors. Okay. So basically, we can do the same with portfolio management or anything else. And in fact, people have been doing this. Okay. So for example, let's say we do this. This is Russell 3000. Okay. So we have 3,000 stocks, and we have dimensions. So we have 10 dimensions to 10 vectors that we're looking for, and each has 3,000 stocks, and just for one day. So we have a price, the closing price for that day. We have intraday range volatility, market capitalization, beta, and it's a 3-year beta. Like most of this data is from Yahoo, except for these three, which is our company generates. Again, using big data techniques for capital markets, we estimate this aggressive HFT, institutional buying is percentage of volume, and institutional sell. So we run this SVD on this, and this is called a scree plot. So the scree plot is basically it's all we're doing is charting the singular values we get from this SVD analysis along their size. So the most important ones are the biggest ones is beta, then followed by price. And here's kind of an obvious bend in the curve, but it doesn't go directly to zero. So this is kind of a blow up of starting from market cap. So there's a curve, right? But it's considerably smaller. So it's market cap, dividend yield, and then institutional buy activity, aggressive institutional activity. And here the daily return, variance volatility, and 10-day volatility that are often most commonly used for portfolio analytics, right? So in a sense, what's interesting about this chart is that the traditional analytics can be in principle replicated by other factors, right? And it kind of makes sense. And the reason it makes sense is if you look at price and beta, so these are the two biggest ones, right? So beta is the market risk, and the more market risk you have, and basically everything now moves according to ETFs, right? So if the stock belongs in an ETF, then you can basically guarantee that there is a high-frequency trading out there arbitraging that particular ETF versus the basket of stocks that are comprising this ETF. So keeping it in law of one price and in considerable equilibrium most of the time. So because of this, like everything that's part of the ETF is moving along with the broader market, and basically everything is part of the ETF right now. So, and beta becomes very dominant. So if you have a correct forecast for the market for tomorrow, you can pretty much, very accurately predict where your stock is going to go. And the price is just a kind of a qualification as to how much in dollar terms your price stock or your stock is going to increase. Because if you know beta, you know the return. If you know market return and you know beta, you know the return, and then you determine the actual gain. Right? So that's that. If you look at the next two dimensions, which are market capitalization and dividend yield, and market capitalization is really a proxy for liquidity. So you have it's how much you can buy or sell, right? How many players out there with holding your stuff are there? And dividend yield is also part of the return. So in themselves, they're kind of also qualifications for return. Interestingly enough, this is what Barra sells, right? So Barra, MSCI Barra, they run the singular value decomposition on equities, and they basically the market capitalization, dividend yield, and a bunch of other macro factors are part of that framework that is used to with the variance covariance matrix to really by portfolio managers. Okay, so it's already out there. It's people are buying this and paying a lot of money for it too. And this is something that we provide. So it's institutional activity and aggressive HFT. The way we estimate it, again, we're using big data on tick data, and we're looking for specific patterns. And for example, the institutional buy, most of the institutional activity today is traded via several algorithms, right? In which VWAP and TWAP are probably the most prominent. VWAP in equities and TWAP elsewhere. And they actually, when you look at the order flow with your eye, and it's everything is broken down. So you don't want to put a large order out there because everything else is very small now, right? So all the orders are now like 100 shares and stuff. And so if you put the 1,000 share order, it's going to be very visible. And of course, because you're putting money into that order, it's a very credible signal to other market participants, because they think, okay, this guy really believes it because he's putting all this cash into it. So everybody's going to pounce and essentially go up to your order. So even though it's anonymous, but you're going to seriously move the market. So instead, people break it down into small orders, and there's a VWAP, which breaks it through the day on a kind of a U curve. It's volume weighted average price, and TWAP is which basically breaks it into even slices. But regardless, it's from the this big data techniques, and it's very visible to the machine eye. So it's not necessarily visible to people, because all you see is a bunch of 100-share orders back and forth. But essentially, you can reverse engineer it. An aggressive HFT is a subset of strategies that executes using aggressive orders. So it's either market orders, so it's you take liquidity taking orders, and you cross the spread, or close to market limit orders. So if it's an aggressive limit order, and it's basically guaranteed or near guaranteed to execute, it can also be comprised. It also consists of being high frequency trading. It can be both short-term alpha. It's always short-term because high frequency trading, but it can be alpha driven, in which case there's some information or idea that is, or usually it's algorithmic, obviously. It's not the person's idea, but the algorithm detects something and they accumulate a little bit more position than usual, or it can be stat arb when it balances off very quickly, in which case it's very balanced. So the bottom line is these strategies, because they're aggressive, they erode liquidity, right? So the opposite is a passive HFT, which is purely limit orders, like market making, which naturally supply limit orders, right? And some people claim that this passive HFT is flaky and blah, blah, but bottom line is markets are anonymous, so you don't know who is HFT, who is non-HFT. And if your order arrives and the HFT's order is the best order out there, you're going to be filled with that particular order, right? So the HFTs don't have the ability to say, oh, I don't want to fill this guy. Like my limit order is there, it's all of a sudden best price. I'm not gonna fill this person. Like if it's there and it's best price and the market order is arriving, you know, it's going to be filled. So it's not truly flaky. It's actually just regular. But the order cancellations are largely free. So there are a lot of obviously order cancellations going on, not just by high frequency traders, but also by execution desks, right, who hold priority for their customers, and then perhaps they take the orders out if the customer doesn't arrive. So anyway, but these guys are eroding liquidity. So they're really, they're taking aggressive positions and they're wiping out liquidity on the other side. Usually takes about 20 minutes for liquidity to naturally replenish, unless there's another event where there's a significant kind of imbalance, in which case they wipe it out again. But in itself, this kind of wipe out of liquidity, it increases the spreads, right? So there's a larger bid-ask bounce. And as a result, there is a risk contribution. So at the end of the day, you will have a higher risk. If you're estimating using realized volatility especially, you will have a higher number, right, for volatility than you would have if high-frequency traders were not present, these particular high-frequency traders. Right, so the passive high-frequency traders is the opposite, because they provide limit orders and they reduce volatility, this realized volatility, because there's just more padding, if you will. And institutional activity, as you said, is really value-weighted average price, or TWAP, which is time-weighted average price, and now it's going mainstream pretty much everywhere. Right? The reason time-weighted average price still used is in some markets like foreign exchange, you may or may not be able to get the actual volume. So since some venues or some participants don't quote you volume, they only quote you best bid and best offer and the best sizes. So there you can't really do the volume weighted average price. Anyway, so this is just how it looks on the chart. So this is again Russell 3000. On this dimension is increasing beta. This stops with increasing beta. This stops with increasing price. Just for fun, the larger circles have more aggressive HFT than smaller circles. And what you really see is a concentration of stocks with small beta along this dimension. And then there's a slight slope. So the smaller is the price of the stock, the riskier they are, according to SVD. And you have a bunch of high-frequency traders for some reason. And this is just the secondary character. So this is institutional buying versus selling. So institutions tend to prefer to buy and sell kind of the same universe of stocks. And this again percentage by volume. So when there's no institutional buying or selling, high frequency traders are prominent, possibly because there's they're a larger share of the volume because institutions are not in the market. So it's not exactly. Anyway, so these are the last dimensions. So previous day's return, intraday range volatility, and then we can extend it to the last 5 years of returns and etc. But these are just like traditional variables that are used in classic portfolio optimization, including the return, right? Because it's used in various matrix shrinking, etc. And they're really very small. Okay, so this is the same SVD. This is this is actually across 500, and it's a mixed bag. There's foreign exchange there, and commodities, and fixed income. Okay, so the various names, including gold and Australian dollar, et cetera, but bottom line is it's kind of and we have limited data on some of them, so just kept it to 4 variables here: best bid, best offer, and aggressive sell and buy. And so best bid is the most kind of dominant variable, and can describe individually various financial instruments according to this. Yeah. This is the actual value, the singular value. It doesn't necessarily have an interpretation. It's something that you combine with the other. It's more from yeah. So yeah, it's exactly that.
So let's say it's an eigenvalue, right? So that means best bid has the most dominant impact on what?
It's not on. This is. So we have so in this case we have securities in rows. Okay, these are four columns.
Okay.
So if you wanted to describe a security, right, you would, in this case, you can just do it by best bid. There are 500 securities, and you can by best bid you can just differentiate.
This is the characteristic of the security.
Right. So this is the most dominant characteristic of the security. Okay. But they're you can put yes, go ahead, put it differently. Yeah, so in this case we don't have the volume. We just don't have the volume data, right? But yes, so definitely. I mean, in a sense, here, I mean, market cap kind of proxies for volume, but not really. But it's certainly something that you can do. I mean, there's so many ways you can really slice and dice this data, and it's not many people have really like done extensive, even like it's not widely kind of established, right? And if you talk about intraday volume is very sparse because there's so many exchanges now. So in the US alone, I think there are now 19 exchanges, equity exchanges. And in total, if you consider exchanges and dark pools, there are 63 or 64 trading venues, right? So because of this, and then there's, on the background, there's an NBBO. Now, NBBO is a national best bid, best offer. And so what it does is it's part of Reg ATS that came out, I think, not Reg NMS that came out in 2005. But what it said is in the interest of investors, all orders have to be executed at the nationally best available bid and offer. Okay, so if you send an order to an exchange and they don't have a nationally best bid or offer, excuse me, by law they're required to forward it on to another exchange. So what happens then is so you have limit orders on every exchange, best bid and best offer, and each exchange submits these orders at a certain time interval, and it changes, it shrinks all the time, to what's called a Security Information Processor, or SIP tape, which is run by the SEC, and where they aggregate it and they determine, like, within every interval, this is what our best bid and best offer is. Okay, and they disseminate it back to the exchanges, and the exchanges may only execute if they have the best bid, best offer that's matching or better than the one that's provided by the SIP. And there are obviously various issues with that because
it's not true anymore. I mean, the exchanges are making all from the other
exchanges, the SIPs are way behind.
Yeah.
Almost.
But do you mean matching agents beyond the internalization?
Meaning they're pulling in all the raw data from all the other exchanges and they're maintaining their own order books. They're not using the SIP order book.
But they have to reconcile still. They have to show evidence, right? That they're.
I don't think so. I think as long as their technology passes muster and passes all the levels of everything, I mean, the exchanges still have the ability to play self-help against each other also.
Right.
So there's that way out if they see that somebody else is acting kind of funny. But I don't think anybody's relying on the SIP anymore.
Interesting. Well, it's there. I mean, there's still, it's a mandate, right, to have it. And I think if there is an issue, then the government would step in and they would match it against it, right? So maybe the redistribution part, as you're saying, is
I think you can do the same thing with an ISO order also. You don't have to hold by NBBO as long as you can present that you have exactly what the order book looked like at the time you sent the order.
Right. Yeah, but still, so it still opens up for a lot of games, right? So for example, you're an exchange, and this is where this whole concept of flickering orders comes in. It's like you're an exchange and you want to get extra flow. So you kind of put on and take off a limit order that's kind of matching or better than the best available order out there. And then you take it off very promptly, but not before it actually is sent out to, in this case, many exchanges and the SIP, and it registers everywhere. And all of a sudden, all the flow from all the exchanges flows to your exchange, right? And so by then, of course, you may not have, you may not want to execute at that price or whatever. You may not have that order anymore in books, so you have to send it elsewhere. But if you have somebody who is specifically subscribing to your feed, they would obtain this information about the orders, right? So what are the orders can you possibly get at this second if you did have this price, right? How much interest is there? And you would get all these market orders streaming to your exchange. So there are different kind of things. In fact, we did a study on one of the exchanges, and it's only, again, a very small fraction of the orders is executed, but there's a lot of these pinging orders, and it doesn't attract algorithms. So algorithms just completely gloss over those. They kind of are capable of identifying that this is really not a real order. But people who are human, they're definitely getting hooked on these. So you see some orders that are pinging exactly like 999 milliseconds, for like a fraction of a second, and then they just go dark until the next 999 milliseconds, and the humans totally recalibrate and they pounce on these. So it's definitely, there's a delay, like kind of in the reaction that you can see from market participants, but it's a very interesting problem, but it's also obviously a risk from the real-time perspective, and there's a lot from big data perspective that you can do to identify those too. So anyway, so from the long-term portfolio perspective, so long-term portfolio managers, they don't concern themselves with execution, right? So execution is all fun and dandy. It's not their function. It's somebody else's job. But what they want to do is create the risk-return characteristics. A traditional approach is you do min variance optimization. But as we said, it's low on the singular value decomposition scale. So how about upgrading to the higher values? And I'll read the book shows up. But so Barra, as I mentioned, has been selling MSCI Barra has been selling the risk factors as inputs for actually quite a bit of time, including like market capitalization and stuff. But there are other things, and in addition to institutional flow and aggressive, but there's lots of microstructure that is completely unexplored, and there's a lot of data, and there's a ton of stuff, and of course there's a lot of risk that is coming up with that. So our book does not have any equations, just FYI, but and it's coming out in a couple of weeks. But basically, here's a step-by-step approach. So you have this decomposition. In the middle is your singular value matrix. Right, so and basically you can take this and multiply it out with your available matrix, whatever the mean variance matrix you're using, and it's very predictive. So one day ahead, you have pretty good. So this is what you predict based on your previous return. So if you do this beta plus price, 2 factors, dividend yield plus market cap, this is the annual Sharpe ratio. This is HighFrequency Trading and return for volatility or the last 4 factors, whatever. So it looks pretty good on paper. It usually doesn't quite work out like that in real life. So this is based on 1-day performance for 2005. Okay, so this is very market sensitive, right? So if market goes up, then if you're relying on beta plus price, then it's going to go, your portfolio is going to go up. This is less market sensitive, but it's still a bunch of stuff. So anyway, so there are various ways you can slice it. This is if you only reallocate once a year, and you can do the same for annual reallocation too. And this is for 2016, so it works a lot better. So I can take this off. But it's basically, and you can combine it with your existing portfolio management technique, right? So whatever mean variance matrix you already have, this is just an add-on, and you know, you can tweak your matrix just by that. So anyway, so it's very persistent across a bunch of factors, but the actual the existing we're poorly. I mean, the key here is what we have now because of ETFs. Once you have a flash crash in one instrument, essentially it spreads very rapidly because there are several factors. So one is, of course, there's an arbitrage between the basket of the comprising the ETF and then the ETF itself. But second, even if you have a large institution that's holding a large position in something, and there's a crash, and they're not sure if it's a flash crash or if it's not a flash crash, then instead of selling that particular security, then they may choose to sell something that's similar, right? So they may choose to actually sell that ETF itself, and especially if it's more liquid, and just liquidate the entire position or whatever the amount, right? And then gradually rebalance it with the original stock that they wanted to sell. And it's an execution strategy, right? So instead of selling off the stock that you actually, if there's a flash crash in one instrument or a crash in one instrument, instead of selling off that stock, you sell an ETF that comprises that stock, right? And then you gradually balance out the ETF versus the stock. The stock may be not so liquid in the first place. So because of that, there's like, so as soon as something happens to one stock, the entire market just tanks, right? And so all of the factors, the daily factors, they really have trouble with this, like the beta, etc., because they're heavily dependent on the market, and it's a problem. I mean, it works, but it only works great when the market as a whole is going up. So if the market is going down, it doesn't work so great. Now the microstructure, on the other hand, it's a completely different. It's independent of the larger market movements. Like even if you look at the correlations, intraday correlations, right? They don't exist. They break down. It's the Epps effect because they're so liquidity dependent that the larger kind of daily portfolio optimization does not apply here at all. So it's a very different. If you look at microstructure, it's a very different portfolio input, and it's in a way it's immune from larger market movements. And so yes, so there's a real impact, and for many different things that we talked about. And you can improve returns and Sharpe ratios, etc. And obviously we have a book that again has no equations in it, but it's kind of an overview of where the market has evolved and what fintech companies are there doing what and stuff like that. Okay, so this is the end. Thank you very much. Any questions? Yes.
I know you have the other chart about the up there that showed kind of how HFTs tend to have more impact than lower price stocks.
Yeah.
Have you found anything kind of like day on day autocorrelation wise where that HFTs tend to trade the same stocks over and over again?
Absolutely. Absolutely. So yes, that's a very good point. I'm glad you brought it up. So the reason why high frequency trading is persistent and then why it's a valuable impact into these long-term portfolio models, even the annual, even annual reallocation, is because high frequency traders are basically they're computers, right? That they're assigned a certain dollar amount to trade every day. And this dollar amount typically does not go from like $1 million to 0 in one day. So it's typically scaled, or like larger amount. So it's typically scaled up or down gradually. And so because of this, the models are highly persistent. So within a day, like intraday, high frequency trading may range from 0 to 100% of volume. But over time, Google has been pretty stable at like 36% for the last 2 years. All right, so it may change to 37, 38% one day, and then it may go to 40% the next day, but it's in the range. Like for high frequency trading participation in a Google stock, it's kind of, it's range bound in itself. So, and the same with other stocks. So the cross-sectionally, for example, in foreign exchange, there's still some pairs that only have 7% of volume that's driven by high frequency trading. And it's been like this for the past 5 years. So because of that, if you're doing long-term portfolio allocation, you're taking it as a factor, it's a meaningful factor because it's persistent. And it will last, it may last for a year. Of course, past is not a predictor of the future, but so far it's been very stable. Yeah.
Do you remember some of the names of the stocks that
Sure.
really have these big circles and
Yeah.
I guess
Yeah,
have a lot of aggressive?
Right. I don't have. I mean, typically, I don't have it. I don't have it here. I mean, typically, Google has a lot of aggressive high frequency trading, and the companies like Apple, it has so many retail traders. Like it's really dominated by retail flow. That there's not comparatively there's smaller percentage of the volume is aggressive high frequency trading is because there's just so many retail traders trading it every day. But generally. What happens is for a high frequency trader, the main cost is the spread, right? Because high frequency traders go back and forth, and if they have to cross a spread, if they're doing aggressive, right, then it's a big cost. So, and the minimum cost you can have as a spread, there's of course it's set, right? It's a tick, right? So in comparison, so it's the higher is the price of the stock in principle, the lower becomes your cost, the minimum cost you have to overcome. So because of that, you see kind of a fair number of high frequency traders, well actually with a higher price. So I guess they're not in this category, but they would be below this range relatively, right? So these are extremely high prices. But like Google is an example where high frequency trading is fairly high, and it's a fairly high price stock. So you will not see a lot of high frequency trading in like a penny stock because it's just very expensive to do that. Yeah, I mean passive high frequency trading. I have to qualify. Passive high frequency trading is very prominent, but not aggressive.
Yeah. Not just spread, it's spread in terms of your price, right? So for passive side.
Right, for passive.
$1, stock price, you have 1 cent spread. That's pretty decent in terms of this point.
Right.
Yeah, pretty much $1, then you earn 1 cent. That's
Right.
100 basis points.
You see any difference after the stock split or reverse split?
Absolutely, yeah. So any discontinuity. I mean, again, high frequency trading is a computer program, right? And in most cases, it's too complex to write every possible scenario into a computer program. So what happens is when there's an expected stock split or some action, that people just typically turn the computers off for that period of time, which to avoid the discontinuity. So when there's an unexpected stock split or a dividend, and some people perhaps may not, it's actually high frequency traders tend to avoid like high dividend stocks, right? Because unless you want to like actually write it in, right? If you want to code around it, but it just creates a discontinuity to the microstructure because you have some jump. Yeah. Yeah, so aggressive is the one that use market orders or aggressive limit orders. So these are limit orders that are very close to the market price. Versus passive are the ones that use limit orders that are spread out throughout the limit order book. Sure. Yeah, well, the easiest way to explain this is, I think, to look at how we do this, right? So these are well-defined algorithms, right, where we use big data to actually get them out. And the same with aggressive HFT. I mean, it's basically based on our knowledge of aggressive HFT strategies, we do this. And of course, there is innovation in the HFT space, and it's continuous. But in most cases, and most of the strategies out there, you have a person who, and there's even a joke, which I read again on LinkedIn, but there's a joke about quant life cycle, right? So you have a quant who comes in and typically brings a strategy from another shop, right? And so they sit in the trading desk, and the first year they have this blowout year because they took a strategy from their previous workplace, and they're just killing it, and they have a really nice bonus. And the next year, they really have to innovate and produce something. And there's a large number of people who can, and there are a lot of people who cannot, right? So, but it's really the testing year of whether you can actually develop any strategies. And in the third year, I mean, if you develop something, that's great. You get a good bonus. But, in many cases, people have to leave. So it's a 3-year life cycle. So after 3 years, the same person takes the original strategy that was a big hit, and they go to the next shop and they implement it again, right? So that's why you have this huge concentration of kind of similar high-frequency trading strategies. They may be slightly tweaked, right? But you actually have these waves, like you can see in data, where there's a lot of all the high-frequency traders all of a sudden are moving this way, right? Or like in the particular security, there's like surplus of buy orders versus sell orders because everybody's doing the same thing. So I mean, there are different strategies, but fundamentally, it's like there's a thing. But I have a book on that too. It's called High Frequency Trading. Yeah. Yes.
I wonder if you have some time of day for your real time, some increment, or where you're able to aggregate.
We take every single data point. So we buy the data from exchanges, and we just take every single canceled order. Like
Okay, but you update explicitly what's your update?
Oh, for our data that we stream?
Yeah, if you work to pay for it.
Right. So right now,
what kind of data?
Sure. Yeah. So for institutional, right now we update every half an hour, and it's an aggregate. It's basically an average for the past half hour of institutional activity. And for aggressive high frequency trading, we do it every 20 minutes. And the reason we do it is we find that it's the most, it's A, the most predictive, and B, it's really sufficient. And it's all based on analysis. But the reason it's most predictive is, again, you have a bunch of high frequency traders that went through different shops, and their models are slightly tweaked, so they execute almost at the same time, but not quite, right? Because some models are older, some models are newer. So when they come together, this is where, you really have this impact where there are a lot of high frequency models doing the same thing. And you can't really detect it on like a 30-second even scale, because then you get a bunch of individual orders and you see that they're high frequency, but you don't know if like it's some guy who just started a new model, right? And it may not be like really prevalent, and it's not going to have the same impact.
And then what's your interview? And you have to defend like trading again.
Oh boy, it was a long time ago.
I wonder if something changes.
Well, I think that high frequency trading is good. I mean, I really believe that high frequency trading is it's automation. It's really it's not a lot of people like, used to believe it's malicious and blah, 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 but it's not. I mean, it's you take people, and unfortunately, automation is coming everywhere, right? So we're talking about basically any aspect of your life. You have driverless cars. You have, well, it's true. You have, like, you name it, right? So I'm really struggling. But you have, like, these robots that cleaning the floors. You have, now complete home automation where, you can turn, like, we turned the heater in the house from New York City, right? Our house is out on Long Island. So it's it's all of this stuff. It's out there. You can have visual recognition. If I came across this cool bell and people ring it and it takes the picture, but not only does it take a picture, it identifies the person. So it sends you a text message with who is at your door, and then you can click through and actually look at the picture, who is there. And so there is all this cool stuff that people are working on. And it's really boils down to, it's either you're doing this and then it's big data, but it's either you're doing automation or really people are going to live in virtual reality, right? So, because I don't know what else is there to do, right? I mean, I'm sorry, I'm part of me is cynical, but I think it's a very realistic scenario. And having tried virtual reality recently, which again is a lot of automation, and it's very complex, and there's a lot of definitely big data analytics going on in that. It's really something else. So yeah.
And go back to the
Sure. Which one? Street plot? Yeah.
I'm just thinking of that. So like those components should be independent of each other. So
They are.
each one should be a combination of the factors. So how can I say the first one is data, the second one is
By elimination. Right, so you try just using beta, and they're so stable. These components are extremely stable. They literally, the value doesn't change if you just have one vector thing. So if you just plug it, well, not one, but let's say you take the first 3 vectors, right? So in whichever order, and you get certain values, and they're extremely stable. Like they don't, because they're independent. They're eigenvalues, right? So they're completely orthogonal. And by elimination, you can, I mean, there's some software packages that actually give you the names of the vectors, but in many cases, you can just figure it out by trying different vectors and see what comes out. Yeah.
It's weird that, like if I looked at a pair of stocks, right, and I simply said, look at daily changes, this sounds very naive. Daily changes in the beta of the stock versus daily change in the price, right? There's no reason why they have to be empirically uncorrelated, right? I mean,
Totally, I agree.
right.
I
It seems
completely
sort of
agree.
weird that you're able to,
Sure.
you know what I mean? It just seems counter to like the observation you're making here, right?
Sure. Well, this is a normalized return, right? So it's a percentage, right? So it's not the difference, it's not the price difference. It's a percentage, and because of that, I mean, we don't know what the value was yesterday, or we do because we calculated this, right? But it's unrelated to what it's here necessarily, percentage-wise. It's kind of it. So basically, what this is saying, that this is like the third most random. It's noise, right? It's essentially saying that the returns are not meaningful at all. Like they're really a noise in the kind of information system that's out there. And perhaps they're noise because there's so many people, using them. It's like a classic, right? So it's just traded out. So it definitely did not start out to be this way, right? Yeah.
We talk a lot about HFT. Just go back to this portfolio construction, you portfolio allocation. Because I'm struggling to understand. So, I try to deal these as factors, right? So, in terms of portfolio allocation or construction, I usually use factors for 2 purposes. One is use factors to make price predictions, return predictions. Number 1. Number two, will I use these factors as way to gauge my risk exposure? Right. So it's not factored into the return, but whether I want to be fully exposed to HFT, kind of risk. So in this case, how do I use these factors?
That's a very good point. So the way I did here, and it just completely, it's kind of, off the wall kind of thing. So we take the, we stream HFT is just, you can just take it 1 plus HFT for a given period, right? And whatever we have. But in this case, this matrix gives you the value for, and the stocks again in this model are in rows. Okay, so each row corresponds to a stock name. So this matrix, which is called the user matrix, it gives you the importance or the coefficient for each stock vis-a-vis the single values, right? So all we did here is so each of these rows, like for let's say the first stock, which is Apple, it can be 5 for market beta, and then 4 for price, right? And then all these individual things. And then you have these singular values for each of these, say, variables. So we just multiply it out. So it's like 5 times beta plus whatever, 4 times price, singular value of the price, not the actual price, right? So and it's not necessarily the way you would do it in the regular thing, but if you think about when you're doing like the matrix shrinking operation, right? So you have a variance covariance. And implicitly, this stuff already incorporates variance covariance of different elements, right? Because you're deducing the eigenvalues. So, but when you're doing the variance covariance shrinking, you are incorporating the return, and you are incorporating the stuff to make it more predictive of future, right? So you're tweaking stuff. So it can be thought of in the same way. So anyway, so here what we're doing is just doing that, and we're multiplying it by lost years return, returns of previous however many days sequentially down. And this is what we predict, right? So, and this is what we actually obtain. So the error is actually best to know to be the smallest score institution with HFT, but there is there's a huge variation. So again, there are better ways of doing it, right? And I'm sure there are very, very complicated ways of doing it too. So it's just a very basic toy model, if you will. Okay.
Okay, well, if there aren't any more questions from the audience, thank you very much.
Thank you. I really appreciate the questions. Very